Now let's take a look at the bigger picture. Anne McCabe's with us, CEO and partner at Curo Private Wealth. Thank you for being here. So we've begun the second quarter and it's been choppy this week, I mean, you could say. How are you feeling?
Yeah, great to see you, Nicole. And it looks like we both got the pink memo. So good to be back on. Thanks for having me. Yeah, it has been a choppy week, but I think it's important to remember that the first quarter started off with a bang. We saw the best performance that we've seen since 2019, with the S&P up over 10% for the first quarter. We're also up about 29% off the lows that we hit in October of 2023. It's actually been one of the most robust rallies of any of our lifetimes anyway. So it's time for the market to take a little bit of a pause and have some time to digest. One of the things we're feeling great about and we're really excited about is we're seeing the rally broaden. One of the stories last year in 2023 was all about the Mag 7 and that the Mag 7 was responsible for most of the growth that we saw in the S&P 500. And the good news is we're seeing that broaden. So more of the non-Mag 7 or the 493 other stocks of the S&P 500 are actually participating in the rally. So we're seeing equal weight do well this year. We're seeing small and mid-sized companies go up in addition, obviously, to the S&P 500. So we're feeling pretty positive.
Yeah, and people have seen that over the last, 6, 8 months, short-term bonds and equal weight on the S&P 500 has worked. And because we're higher for longer, saying this could just be the way to go, at least for now. Do you think that's right?
I do. I think one of the things we're seeing, and certainly this was confirmed this week on Tuesday when we saw a little bit of volatility in the market, is the market is reckoning with the idea that it got it dead wrong at the beginning of the year. The market was predicting 7 rate cuts, and obviously it's now come more in line with the Fed at about 3. And the reality is that if the Fed was in a position where they had to reduce rates by 7 times this year, that probably would not have been positive for the markets. That probably would have been induced by some sort of crisis, which is not good for the economy and not good for the markets. So I think we're in a position where good news can actually be good news. And I'm not sure we've been there for a while.
It's interesting how September is now the 92%. The summer is no longer on the high end of that. July is at 77% for these cuts. The Fed talking more about pushing this back and staying where they are. Bostic has been the one cut this year. Man, I mean, he's been saying that for some time. So you think that's right? Because I've actually heard that the economy is not that bad. And even if they do the one cut, that could be an error. And maybe that would be a good thing for equities.
Yeah, the Fed is data dependent. I believe Powell and others when they say that. But I think one of the things we have to put out there is the large presidential election that we have coming up in November. And even though the Fed is not a political organization, historically, they do not like making big policy changes too close to the election. So we actually think they either go on the earlier side, say June or July, or they wait until after the election. And their November meeting actually starts on November 6th, one day after the presidential election. So I think it's either sooner or after the election.
Yeah. You said if you're underinvested, maybe you should wait for a little bit of a pullback to put some money to work?
Yeah, I mean, historically, election years do come with more volatility. We certainly have not seen that this year. And even this pullback that we were talking about this week, that was very short-lived, right? As soon as Powell came out yesterday and reinforced the message that rates will probably come down this year, that pullback disappeared. But we do expect the volatility as we get closer to the November election will probably pick up. There is tons of cash on the sidelines. So if you are an investor who has too much cash on the sidelines, you're underinvested, or even worse, not invested at all, we do think if we see pullbacks closer to that November timeframe to take advantage of them and put money to work.
Right, understood. And then emerging markets, not something people follow as closely. What do you mean when you see opportunity there? Could you be more specific?
Yeah, absolutely. If you look at since 1988, if you look at the last 5 cycles where the Fed has stopped increasing interest rates, 2 years out, emerging market stocks have performed pretty well. So they have been positive in 4 of the last 5 cycles, and the average returns have been positive 29%. So for those folks who are interested in more of an opportunity, taking advantage of where we are with the Fed and interest rate cycle, emerging market stocks could be a good opportunity to look into. I will say we like active management in emerging market stocks, not passive. You do not want to own the entire emerging market index. So look at an active manager there, but certainly something to consider for longer term investors and folks who are comfortable with a little bit more volatility.
Are you comfortable with China? Because sometimes people say emerging markets ex-China.
Yeah, we have been in the ex-China camp up until recently, but of course, from an investing standpoint anyway, there is quite a potentially attractive opportunity in China. So we are slowly adding to positions that do have China exposure now. We wouldn't go full 100% China, but EM with China we think probably makes sense in the long run.
All right, Anne McCabe of Curo Private Wealth. Thanks, Anne. Good to see you.
Good to see you too, Nicole. Take care.